Banks panic as lending demand crashes. I'm your host, Steven Van Metre, and thanks for joining me today. With interest rates surging higher, borrowers are walking, creating an even bigger problem for banks and the financial system, which is desperate for new money, as the Fed now proposes that it's going to start unwinding its balance sheet this summer. Let's pick this story up. We'll head over to Bloomberg as U.S. home refinance gauge slides to three-year low as rates rise. MBA refinancing gauge drops nearly 10%, and purchases are also falling as rates hit new highs. A measure of applications of refinance at U.S. homes slid last week to a three-year low, and filings to purchase a property dropped by the most since mid-February as mortgage rates continue to climb. The MBA's refinancing index slumped a whopping 9.9% in the week ending April 1st, which is critical because when you understand what's going on here is we need new loans to create new money in our economy. And without it, well, things get really bad. Let's keep going with the story. As the MBA said, the average contract rate on 30-year fixed mortgage rose 10 basis points to 4.9%. Now, I remember when I got my first mortgage, it was just under 7%, and I thought that was a phenomenal deal. But when you come up from levels at 3 and 4%, 5% is pretty high, and it's going to keep a lot of buyers off the table because they just can't afford those extra payments. And that's the swiftest rise since 2003. Effective rate, which includes the effects of compounding, rose to 5.06%, the highest since late 2018. And here you can see mortgage rates have surged higher all the way back where they were before they came crashing down after they peaked in 2018. And mortgage application volume continues to decline due to rapidly rising rates, something I've suggested repeatedly. And refinancing now makes up 38.8% of all mortgage application activity, down from about 60% a year ago. And it makes perfect sense when you think about it, is people do not want to refi at a higher rate unless they have to, unless they need to cash money out or there's a financial reason they absolutely must. Most homeowners will not want to refinance at a higher rate, and that has major impacts on the interest rate market. Let's take a look at the refinance index from the MBA. And what do we note here? That it's been sliding and continue to fall and is almost now at levels not seen since late January of 2018, and back when the index was around 800 to 900. Here we're at under 1200 and falling rapidly. And this has major implications again on the bond market. Is here we can see yields going back to mid to late 2018. Actually, you see how they flattened out here. They kind of had a blow off move higher and then just went steadily lower. And why is that? Because a lot of people don't understand there's a supply and demand component for interest rates. The prevailing view today is interest rates can and only must go higher. But there's one thing that people really miss from this whole perspective is, what if nobody wants to borrow at higher rates? Well, if no one wants to borrow, rates have to come down. And we see that in the MBA data here, telling us that this, as applications fall, well, so too do rates. Maybe it's a lagging effect, but the rates will indeed fall. And so now we have here where everyone thinks is rates going to go higher, but the mortgage refinance data suggests rates are actually going to come crashing down. And why is that from a banking perspective a problem? Because, well, if you're a bank, how do you make money? Well, you make money lending against deposits. That's what you want to do. But what happens when rates go higher and buyers say, no, I'm not interested in borrowing at that level, and you still have money coming in on new deposits? Well, you have to pay interest on those deposits. And so what do? Instead of lending against them, you have to go out and create what are called bank reserves. And that's when a bank buys U.S. Treasury securities or mortgage-backed securities with customer deposit money and uses that interest to pay them on their deposits, and the bank takes the spread, the difference on it. Now, it's a lot less than the bank makes on a loan, and it's important because banks would prefer to lend here. And here you can see on this chart, deposits in blue have far outpaced loans and leases and reserves. So I even included reserves created by the Fed, putting the banks in a position where they're going to have to continue to buy Treasury and mortgage-backed securities as their balance sheet needs. But one thing that came in the news that we've been talking about, and I'm almost surprised that the headline from Zero Hedge didn't say unexpected WTI dip, but it didn't. It said WTI dips after crude production rise, inventory build, and you already know where we're going with this because I've said that we're going to see crude oil prices come down, but let's go through this again because oil prices have been volatile so far today, but are higher for now after dropping on headlines from Bloomberg reporting that the International Energy Agency plans to place 60 million barrels of crude on top of the huge stockpile release release already announced by the Biden administration. And here you can see Cushing inventory. Now remember, a barrel of WTI is a barrel of gasoline, and Cushing is really critical in that. And it rose, inventory rose 1.651 million barrels this last week. And what we can see from this chart, which is phenomenal, is when Cushing inventories are at low levels, and historically low levels in that case, they head higher. And well, we're starting to see that trend building now, despite views that this isn't going to happen, that it can't happen. And what does that mean for crude oil prices? Well, we can go back to mid-2014 and see when inventories levels bottomed out, crude oil prices came down. Here we can see it again in 2018, prices came down. And what's going to happen again? Regardless of whether we see the Strategic Petroleum Reserve release or anything else, as long as Cushing inventories rise, then we're going to see oil prices fall. And why would that happen? Even if there's no government intervention, high prices are the best cure for high prices, and also has an impact on the bond market as well. Here you can see on this chart, 30-year Treasury yields, we can see they peaked. You look back to 2014, and we see they peaked late 2013 and then headed lower ahead of oil falling. Here you can see mid-2018, there was a little blow-off move, and then they headed lower too. And so again, we tack on the potential move coming in crude oil heading lower, and that tells us as well with the refinance application crashing, well, that's where we're going to see interest rates head. Now today, the Fed released their minutes from their last FOMC press conference and gave us new light on what's coming in the next couple of meetings. Let's head over to the Federal Reserve website, and we've got the minutes of the FOMC committee from March 15th to 16th, and market participants expected an earlier, somewhat faster reduction in their system open market account, or SOMA, or their balance sheet holding of securities than they did in January. So what we're seeing now is faster. Expectations for this happening sooner are rising. In surveys, almost 90% of respondents projected a balance sheet runoff to begin in July. So there's your number. We talked about the other show, I think yesterday, that there's a potential this could start in May. 90% of the people are saying from the minutes, July, that's where you can expect now this to actually happen. Overall, the survey response expected a significant reduction in the balance sheet over the coming years, although there's a high degree of uncertainty around the magnitude of the total decline. And all they're saying there is they don't know how far they're going to take it down. They're just going to reduce it. Let's keep going because there's more interesting things here. As several participants remarked that they would be comfortable with a relatively high monthly cap. And what they're talking about here is how much they're going to let of their balance sheet roll off every month. I want you to think back when Trump was president, and you maybe remember him tweeting, which obviously not able to do anymore, but he talked about how the $50 billion per month was a big problem, and he didn't like the Fed rolling it off then. Well, wait till you see how much they're going to roll off now. Of course, Biden, maybe he'll be tweeting soon that, hey, stop this madness because you're crashing the economy. That's exactly what the Fed's going to do here. So some other participants noted that monthly caps for Treasury securities should take into consideration potential risk to market functioning. Participants generally agreed that monthly caps of around $60 billion for Treasury securities and $35 billion for agency MBS would be appropriate. And remember what happened then. We saw rates crash, we saw the market struggle, and now we're seeing financial conditions tighten. Is putting the odds of recession up incredibly high. But there's one thing you should not be worried about when it comes to your portfolio, and that's recession risk. Be sure to check out Portfolio Shield. I'll put a link there up in the corner and the description below. Take a look at it when you have time. You'll be glad you did. Let's continue on with what the Fed's got going on. Participants also generally agreed that caps could be phased in over a period of 3 months or modestly longer, and they're saying that to give the market time to prepare for this. So looking starting out at $95 billion, almost double the peak of the last time. Several participants remarked that reducing the Federal Reserve's Treasury bill holdings over time would be appropriate because T-bills are highly valued as safe and liquid assets, as Jeff Snyder has said, and Treasury could increase bill issuance to the public as SOMA bill holdings decline. Participants generally noted that maintaining large holdings of Treasury bills is not necessary under the Federal Reserve ample reserves operating framework and previous scarce reserves regime. Treasury bill holdings were useful as a tool that could be used to drain reserves from the banking system when necessary to control short-term interest rates. So what does all that mean? Well, if you look at the Fed's balance sheet, most of it matures in 2 years, a lot of it, because they bought predominantly short-term bills and notes. They didn't buy as many bonds. And so everyone thinks that the Fed's going to be rolling off the 20-year, the 30-year. They're not. What they're going to do is as these short-term bills and notes mature, they're just going to let them go back to the banks. That's all they're going to do. They're not going to actually hard sell their portfolio because they don't need to. It's going to mature frequently. So they're going to focus on the front end of the curve. And the idea being to drive short-term rates higher, not long-term. Remember, Fed has no control over long-term rates, despite still popular belief that that's true. Some participants noted under the proposed approach to running off Treasury and agency securities primarily through adjustments or reinvestments, that agency mortgage-backed holdings would still make up a sizable share of the Federal Reserve's asset holdings for many years, and they generally agreed that after the balance sheet runoff was all underway, it would be appropriate to consider sales of agency MBS to enable suitable progress toward a portfolio composed primarily of Treasury securities. And so there you're seeing now the Fed taking support from the housing market away, which we talked about, I believe, in yesterday's show, that's going to put upward pressure on mortgage rates and potentially downward pressure on housing prices as affordability comes into question, where new buyers cannot afford both high prices and high interest rates. So you see the Fed setting everything up to a crash coming into the summer, which the timing could not be worse. Now you have the risk that the Fed's going to crash the markets, crash the housing market, stock market, housing market, and over tighten to the extent that the summer season, what many businesses need to survive, well, they're going to struggle through it, and perhaps we'll be back into a recession before we know it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.